IonQ just reported numbers that look like a breakout. Revenue was $64.7 million in Q1 2026. Management said that was up 755% year over year. But hidden inside the same quarter is the warning sign investors cannot ignore. IonQ also reported adjusted EBITDA of negative $96.8 million. So today, the real question is simple. Is IonQ becoming a durable quantum business, or is the market already pricing in too much future proof? Before we talk about valuation, we need to understand why investors are willing to pay such a premium in the first place. IonQ is not selling normal software. It is trying to commercialize machines that could solve certain problems regular computers may never solve efficiently. That sentence is the whole stock story in miniature. Huge possibility, huge uncertainty. Let us make the technology simple. A normal computer stores information as bits. A bit is like a light switch. It is either off or on, 0 or 1. A quantum computer uses qubits. That word can sound intimidating, but for a beginner, imagine a spinning coin. Before it lands, it is not simply heads or tails. It is in a more flexible state. Quantum computers try to use that flexibility to solve certain kinds of problems differently from normal computers. That does not mean a quantum computer is magically faster at everything. It is not replacing your laptop. It is not replacing every data center. And it is not useful for every business problem. This matters for the stock because the market is not paying for today's revenue alone. The market is paying for the possibility that this technology becomes a new computing layer. The opportunity is narrower than the hype, but potentially huge. Quantum computers could matter for problems where normal computers struggle, such as certain chemistry, materials, optimization, encryption, sensing, and simulation problems. IonQ's specific approach is called trapped ion quantum computing. In plain English, IonQ uses individual ions, which are charged atoms, as the foundation for its qubits. Well, the basic argument is that atoms are naturally identical. If you can control them precisely, you may be able to build a more reliable quantum system. That is the promise. But this is where the stock story becomes dangerous. There is a massive gap between a promising technology and a scalable public company business. So what does IonQ actually sell? Most people think of IonQ as a quantum computing company. That is true, but the company is trying to position itself as a broader quantum platform. There are 4 buckets to understand. Keep these 4 buckets in mind, because later we are going to test whether they are becoming a real platform or just a collection of early markets. First, quantum computing access. Customers can use IonQ systems through cloud platforms or direct enterprise relationships. This is the most obvious part of the business. Second, quantum systems. IonQ can sell systems to institutions that want their own quantum capability. This matters because system sales can be much larger than basic cloud access. Third, quantum networking and security. If quantum computers become more important than secure communication, quantum interconnects and post-quantum cybersecurity become part of the same conversation. Fourth, quantum sensing. This is less familiar to many retail investors, but it could matter for navigation, imaging, defense, and measurement problems. That platform strategy is why IonQ bulls get excited. They are not just betting on one product. They are betting that IonQ becomes a full-stack quantum company. But that also makes the stock harder to analyze. If a company sells one product, investors can track price, units, margins, and customer growth. With IonQ, investors are tracking a portfolio of early markets, many of which are still forming. That is why the Q1 2026 numbers matter so much. This is beginner trap number 1, confusing revenue growth with business quality. Revenue in Q1 was $64.7 million. For a company that had only $7.6 million of revenue in Q1 2025, that is a huge jump. Management also said about 60% of Q1 revenue came from commercial customers. About 35% came from international customers. And more than 1/3 came from multi-product sales. Those details matter because they suggest the story is not only government research spending or one-off academic interest. Management is saying customers are buying across the platform. The company also raised full year 2026 revenue guidance to $260 to $270 million. For a young quantum company, that is real revenue. It is not just a science project with press releases. But revenue growth is only the opening scene. The real movie is whether that growth repeats, whether customers expand, and whether the company can produce better economics as it scales. But here is the first proof gate warning. One strong quarter does not automatically prove a repeatable business model. Quantum system sales can be lumpy. Large contracts can make growth look very smooth in one quarter and less smooth in another. A system sale can bring a large revenue event, but investors still need to see whether that demand repeats. That brings us to beginner trap number 2, confusing RPO with cash. RPO means remaining performance obligations. In beginner language, it is a measure of contracted work that has not fully become revenue yet. Think of RPO like a restaurant with reservations. Reservations tell you people have booked tables. That is good. It means demand may be coming. But it does not prove the customers already ate, paid the bill, or left a profit. IonQ reported RPO of $470 million, up 554% year over year. That is important. It tells investors that the company has future work tied to signed contracts. But RPO is not the same as cash in the bank. It is not the same as completed revenue. And IonQ's release says RPO includes funded and unfunded portions of contracts. That means investors need to watch how much of that RPO converts into recognized revenue, how fast it converts, and what margins look like when it does. This is one of the most important beginner lessons in the whole video. Backlog can be bullish, but backlog is still a promise to do work. Revenue is the work showing up in the income statement. Cash flow is the work turning into money that stays in the business. That difference is where a lot of stock stories either become real or fall apart. Now comes the number that could fool a lot of beginners. The company reported net income of $805.4 million. For a beginner, that sounds like IonQ suddenly became massively profitable. But this is exactly where you have to slow down, because underneath that profit headline, the operating business was still deeply unprofitable. The same release reported adjusted EBITDA loss of $96.8 million. The company also guided full-year adjusted EBITDA loss to negative $330 million to negative $310 million. This is beginner trap number 3, confusing accounting profit with operating profitability. So what is going on? The simple explanation is this. Net income can include accounting movements that do not reflect the cash profitability of the core business. Adjusted EBITDA is management's attempt to show operating performance after excluding certain items. You do not have to love adjusted EBITDA. You should not blindly trust it. But when net income says one thing and adjusted EBITDA says something very different, investors need to slow down. For IonQ, the important point is that the operating business is still investing heavily. Q1 research and development expense was $125.7 million. General and administrative expense was $88.6 million. Selling and marketing expense was $29.4 million. And stock-based compensation was $128.5 million. That means the economic cost of paying employees and executives with stock is not small. It is larger than the reported Q1 revenue. This does not automatically make the company bad. High-growth technology companies often use stock compensation. Early-stage category leaders often spend heavily before the market is mature. But it does mean investors should not only look at the revenue growth chart, they also need to track the share count, stock compensation, operating losses, and whether the business becomes more efficient as revenue grows. The next major piece is cash. IonQ's Q1 release said the company had $3.1 billion of cash equivalents, and investments as of March 31st, 2026. That is a major advantage. A lot of early-stage technology companies are forced to raise money when the market is weak. IonQ has a much larger cushion. Cash gives the company time. It can fund research, it can hire, it can buy technology, it can survive a slower adoption cycle. But cash is not proof by itself. Cash is the runway. The airplane still has to take off. The proof is whether that capital turns into better systems, more customers, larger deployments, stronger margins, and eventually a business that does not need to keep burning capital to grow. That is why the pending SkyWater acquisition matters. IonQ announced the planned acquisition of SkyWater technology earlier in 2026, and the Q1 release said the transaction was expected to close in the second or third quarter of 2026, subject to approvals and normal closing conditions. SkyWater may be the difference between IonQ being a lab story and IonQ becoming a manufacturing story. Why would a quantum company care about a semiconductor manufacturer? Because if IonQ wants to scale from lab systems into commercial systems, it needs manufacturing discipline. It needs chips, fabrication relationships, testing, quality control, and repeatability. The bull case is that SkyWater could help IonQ build a more vertically integrated quantum manufacturing base. The bear case is that acquisitions add complexity. They add goodwill, intangibles, integration risk, and sometimes distraction. IonQ's SEC XBRL data showed goodwill of about $2.13 billion and finite-lived intangible assets of about $781 million at the end of Q1. That acquisition footprint means investors need to watch whether acquired assets produce revenue and strategic advantage, not just a bigger balance sheet. In simple terms, SkyWater could help IonQ scale, but it could also make the company harder to understand. Now let us move from the numbers to customer proof. One of the most important Q1 announcements was IonQ's first sale of a 6th generation chip-based 256-qubit system to the University of Cambridge. For retail investors, the key point is not the technical label. The key point is that a serious institution is buying a high-end system, and IonQ is using that as proof that its platform is moving toward commercial scale. The company also pointed to DARPA's selection of IonQ's quantum interconnect technology to support heterogeneous quantum computing. Again, this is not the same as saying revenue is guaranteed. But it does show IonQ is involved in advanced government-backed research areas that could shape future quantum infrastructure. The company also talks about post-quantum cybersecurity, sensing products, and global deployments. Management says it has sold solutions in more than 30 countries. This is where the story gets interesting. If IonQ were only selling cloud access to a small group of researchers, the market opportunity would be much narrower. But if IonQ can sell systems, networking, security, sensing, and software-like access across commercial, international, and government customers, then the business could become much larger. That is the dream scenario. Imagine a pharmaceutical company using quantum tools to test molecules, a university buying a system for research, a defense customer using sensing or networking tools, a data security team preparing for a post-quantum world, a cloud customer experimenting with quantum applications without owning hardware. IonQ wants to sit in the middle of that future. The problem is that the future is not evenly distributed. Some customers are experimenting, some are buying, some are still waiting, and some use cases may take much longer than investors want. That is why competition matters. IonQ is not the only company trying to win quantum computing. IBM is pushing superconducting quantum hardware and a large quantum ecosystem. Google has its own quantum program. Quantinuum is a serious private competitor. Rigetti is public and uses superconducting technology. D-Wave focuses on quantum annealing and related systems. This is beginner trap number 4, assuming the best technology automatically becomes the best stock. The point is not that one approach has already won. The point is that quantum is a race with different technical paths. Think of it like several teams climbing the same mountain from different sides. IonQ is climbing the trapped ion path. Other companies are climbing superconducting, annealing, photonic, neutral atom, or hybrid paths. Each path has trade-offs. IonQ's pitch is that trapped ions can offer high-quality qubits and a strong roadmap, but competitors create different kinds of pressure. IBM and Google are ecosystem and capital threats. They have enormous research budgets, cloud relationships, and developer ecosystems. Quantinuum is a private, serious quantum threat. It does not have to explain every quarter to public shareholders in the same way, but it can still compete for talent, customers, and technical credibility. Rigetti and D-Wave are public market comparison threats. If they show faster commercial traction in a specific niche, investors may start comparing quantum stocks differently. And the broader technology field is an uncertainty threat. Superconducting, trapped ion, photonic, neutral atom, annealing, and hybrid approaches all have different trade-offs. For investors, this means IonQ does not only need to prove that quantum computing matters, it needs to prove that IonQ's approach captures a meaningful share of the value. Now, here is the part Wall Street may be struggling to price. Normal valuation tools do not work cleanly for IonQ. Price to earnings does not help much because the operating business is not yet profitable in a clean, recurring way. Price to sales can look extreme because revenue is still early and can be lumpy. Discounted cash flow depends on assumptions nobody can confidently know yet. How fast quantum adoption happens, how much IonQ wins, what margins look like, and how much dilution shareholders absorb along the way. So investors end up pricing probabilities. What is the probability quantum becomes commercially important? What is the probability IonQ is one of the winners? What is the probability revenue scales faster than losses? What is the probability share count stays disciplined enough for shareholders to benefit? That is why this stock can look fascinating and dangerous at the same time. Before the bull and bear cases, let us make the trust test explicit. If I were bearish, what would make me more bullish? 3 things. RPO converting into real revenue. Losses shrinking as revenue grows. Customers expanding from pilots into larger deployments. If I were bullish, what would scare me? Revenue lumpiness. Heavy stock-based compensation. Competitors proving faster commercial traction. And a future where quantum remains impressive in the lab but slower to monetize in the market. Now let us build a bull case. The bull case is simple. What if Q1 was not a one-time spike? What if this is the first sign that quantum demand is moving from experiments into real contracts? IonQ is no longer a company with only tiny experimental revenue. Q1 2026 revenue was $64.7 million, and full-year guidance points to a much larger annual revenue base. RPO is growing. If the $470 million of reported RPO converts into revenue over time, it supports the idea that demand is building beyond 1 quarter. The customer mix looks more diverse than many beginners might expect. Commercial, international, and multi-product revenue all matter because they suggest IonQ is not relying on one narrow buyer group. The cash and investment base gives IonQ time. Quantum timelines can be long, and cash runway is valuable when the industry is still early. The platform strategy could expand the market. Computing, networking, security, sensing, and system sales create more potential revenue lanes than one product alone. And if SkyWater closes and integrates well, IonQ may strengthen its manufacturing foundation. That is the optimistic view. In that version of the future, IonQ becomes one of the few public ways to own a full-stack quantum platform. Revenue compounds, RPO converts, customers expand from pilots into deployments, and the cash balance helps fund the company until the market catches up. Now, the bear case. The bear case is also simple. What if investors are pricing IonQ like the future has already arrived, while the business is still burning cash to build that future? IonQ is valued like investors expect a very large future. If revenue growth slows, if contracts slip, or if quantum adoption takes longer, the stock can fall even if the technology is impressive. The business is still losing money on an adjusted EBITDA basis. A negative $96.8 million adjusted EBITDA quarter is not a small number. Stock-based compensation is material. If share count keeps rising, long-term shareholders can own a smaller piece of the company even while the company grows. RPO is not the same as revenue. It must convert. System sales can be lumpy. One big contract can make a quarter look amazing, while the next quarter may look less dramatic. The competitive landscape is intense. IonQ may be a leader in one approach, but it is not competing in an empty field. Acquisitions can create integration risk. A bigger company is not automatically a better company. And quantum itself may take longer to become commercially useful than investors expect. Early markets often move in waves: excitement, funding, prototype, disappointment, real deployment, then scale. If IonQ is still in the expensive middle phase, the stock could remain volatile. So where does that leave us? IonQ is not just hype. The company has real revenue, a large RPO figure, serious customers, a large cash and investment base, and a platform story that could become important if quantum computing scales. But IonQ is also not a simple proof positive business yet. The company needs to turn backlog into revenue, revenue into better economics, and technical milestones into repeatable customer value. That is the proof gate. In the next few filings, I would watch 6 things. First, revenue quality. Does revenue keep growing without depending on one lumpy system sale? Second, RPO conversion. Does the $470 million backlog become recognized revenue on a reasonable timeline? Third, gross and operating economics. Does the company show that bigger revenue can eventually reduce losses? Fourth, stock-based compensation and share count. Are existing shareholders being diluted heavily, or does dilution become more controlled? Fifth, customer evidence. Are customers moving from pilots and announcements into larger deployments? Sixth, SkyWater execution. If the acquisition closes, does it strengthen manufacturing and product delivery, or does it become another integration burden? Here is my balanced view. IonQ is one of the most interesting public quantum companies because the numbers are starting to look real. The revenue jump, RPO growth, and system sale make the story much stronger than a pure research stage narrative. But the stock still requires patience and risk tolerance. The company is spending heavily, the industry is early, and the valuation can move faster than the business proof. For beginners, the best way to think about IonQ is not as a guaranteed quantum winner. Think of it as a high potential platform company where the proof is now moving from the lab into the financial statements. If future filings show revenue conversion, customer expansion, better operating leverage, and disciplined share count, the bull case gets stronger. If revenue becomes lumpy, RPO stalls, losses stay too high, or dilution keeps expanding, the story becomes much harder. That is the real test. IonQ does not need more hype. It needs proof. Revenue proof, customer proof, margin proof, dilution proof. Until then, this is not a simple winner-takes-all stock. It is a high-potential, high-risk race against time, not quantum hype, not one quarter, not one press release. The test is whether IonQ can turn a very expensive, very promising technology platform into a repeatable business before investor expectations run too far ahead of reality. This is not financial advice. Always do your own research.